Hi, I'm Tom Lydon, editor of ETF Trends, here in Chicago at the Morningstar ETF Conference. And I'm here with Dodd Kittsley, who's head of ETF strategy for Deutsche Asset and Wealth Management. Dodd, great seeing you.
Great to see you again, Tom.
Yeah, so listen, there's a big headwind out there that some advisors know about, few are paying close attention to, and that's currency risk and how it can devaluate your global equity positions. It's a big concern.
It certainly is, as international equity allocations are becoming more and more important and larger in client portfolios. I think investors are looking under the hood a bit more at what are the primary drivers of risk and return in any international equity investment, whether it be an ETF or a mutual fund. And what's emerged is that currencies really are a primary driver that is contributing to risk and return in any international equity investment.
Absolutely. Now here in the US, we have our finger on the pulse as far as what the Fed's doing. They keep delaying, a little bit of tapering, right?
Little dovish.
Yeah. A little dovish,
recently,
okay.
yeah.
But we've had a little bit of a spike in the dollar, and that doesn't necessarily have to be because what the Fed is not doing. It could be what the ECB or what's happened in Japan, right?
Absolutely. Central bank activity is a primary driver of currency movements, and what we're seeing is the Federal Reserve is more likely, albeit maybe not right away, be one of the first to raise interest rates, which can certainly drive and contribute to a stronger US dollar. But what the Bank of Japan is doing, certainly what Mario Draghi and the ECB is doing in terms of continuing to ease monetary policy, continuing to take unprecedented measures in increasing liquidity in their markets really bodes very well longer term for a stronger dollar.
So getting to the basics, if you own a European mutual fund or European ETF and it's priced in euros,
yes,
and the euro declines versus the dollar, your portfolio declines, right?
Absolutely, yeah. I mean, to invest in international equities, you take an investor's US dollar and you have to convert that into the local currencies to buy the securities.
Right.
Essentially, at the time of the end of investment, you have to repatriate that money back. So essentially, it is the change in currency rate over an investor's holding period that can contribute meaningfully to either a boost to performance or, as you suggest, a headwind. And what investors have seen over the last 10 years, it's been a boost. It's been a tailwind that has really buttressed the returns that investors have realized in unhedged investments. We don't think that's going to be the norm going forward.
So you've created tools, the Deutsche X trackers, and they cover a whole variety of global regions. And the idea here is use these tools as a hedging strategy for your global portfolios. Talk about that.
Yeah, absolutely. I mean, it allows investors to control for unintended risk in their portfolio, right? And we've got 11 currency hedged exchange traded funds in the market today, offering very broad exposure such as EFA or emerging markets, down to individual country exposures like Japan and Germany and the UK. So whatever the investor's desired allocation is, they can use these tools to be able to control for the impact that currency would have, either as a complement to unhedged investments or as a potential alternative to, if they want to eliminate that currency impact almost entirely.
Absolutely. Yeah. Dodd, great. More to come on that. Thanks for being with us today.
Our pleasure as always. Thanks,
Enjoy.
Tom.